equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, or should I say, G'day Mates. We're journeying into another thrilling episode of Equity Mates. We're not just horsing around, we're galloping through the financial track. Whether you're a rookie foal or a financial stallion, our aim is to lead you from the starting gate to the winner's circle. As always, I'm joined by my equity buddy Ren, and who am I?
Are you a generic Melbourne Cup horse? Hold on. Is it a specific animal or person?
Yeah.
Are you Phar Lap?
Yes.
There was nothing specific.
I know, it's very general.
Yeah,
very
I was going to go to
general.
Man from Snowy River, but... Yeah.
Wow. Nice. Well played. Well, anyway, enough horsing around. Let's get on with today's episode. And we're joined by another expert who is pitching at the Sohn Hearts and Minds Investment Conference coming up on November 17th. And that is Ashish Swarup, who is the portfolio manager and investment analyst at Aikya Investment Management.
Yeah, that's right. Ashish and Tom Norton, who we had on the show last week, are both getting up and pitching one stock, their highest conviction stock for the next 12 months at the Hearts and Minds Conference. But in this episode, we're going to speak to Ashish about his specialty, emerging markets. We're going to talk about what's happened in emerging markets as we end 2023. And then we've asked Ashish to bring a couple of stocks for us to talk about and unpack. Unfortunately, it won't be the stock he's pitching at Hearts and Minds. He's not allowed to tell us that. But two fascinating stocks, I'm sure.
Yes, can't wait. If you are interested in seeing what Ashish, Tom, and all of the other experts pitch at the Sohn Hearts and Minds Conference, tickets are available for the virtual conference. Equity Mates get a 20% discount on the virtual tickets. The code is EquityMates2023, all one word, and it brings the price down to $400 with all proceeds going towards medical research. So we will include a link in the show notes for you to access that. It's an amazing conference each year.
Now, if you're listening to this episode on the day it drops, as I'm sure everyone does, the conference is tomorrow. If you're listening to this after the 17th of November, whilst you have missed the conference, make sure you're listening to the Equity Mates Investing podcast on Monday, where we talk about all of the stocks picked. So don't worry if you've missed the conference. We're going to be talking about everything we learnt, all the stocks that were spoken about. So you won't miss out if you're listening to Equity Mates Investing podcast. But Bryce, let's get to Ashish. Before we do, a reminder that whilst we are licensed, we are not aware of your personal financial circumstances. Any advice you hear is general only. This show is for education and entertainment purposes only. And always do your own research. And if you feel you need it, seek professional advice. With that said, let's get to Ashish.
Ashish, welcome to Equity Mates.
It's my pleasure. Thank you.
Now, today we're going to spend a bit of time speaking about Hearts and Minds, then dive into all things emerging markets as we end 2023, and then have a look at two stocks that are either in your funds or that you find interesting at the moment. So let's start at the top. You're preparing to pitch at the Sohn Hearts and Minds Investment Conference. Why is participating important to you?
Yeah, thank you. Thank you for the questions. Good question. I think emerging markets traditionally are seen as a very risky asset class where quite a few investors are usually scared away because of the volatility of the asset class. While we believe emerging markets actually offer excellent potential for returns long term. And the way we invest or Aikya is that we want to protect the downside while thinking about good sort of upside long term. So we want to demonstrate this investment approach, or at least, the stock picks as per this investment approach to investors. And that's why we think it's important to highlight that there is a less risky way to invest in a asset class, which is seen as very risky traditionally.
I love that. I mean, the broad umbrella term that is emerging markets is, the majority of the world at this point. So there's so much diversity within that category, and we'll get to that. But let's start with your investment philosophy. You mentioned, I guess, a key element there is, approaching an asset class that is seen as traditionally risky, but approaching it in a way that protects the downside. But how else? What are the other elements to your investment philosophy?
So yeah, I mean, so the first thing, like I said, is the protection of downside risk is quite important. So the way we think about risk is not just minimizing the permanent loss or potential to permanent loss of capital, but also lowering the volatility of returns for investors. And we think just keeping people invested is half the battle, because what happens most of the times is people sort of sell out at the wrong time from the market. They get scared away. So we think this downside risk protection, which is lowering both permanent loss of capital or risk of permanent loss of capital, but as well as lowering the volatility, both are actually important. Now, how we do it is quite interesting. So we look for companies where we think there is a major shareholder. So we usually invest in owner-managed companies. And where we think people have, or the owners have, soul in the game. So it's not just their entire net worth is invested alongside us as minority investors in that company, but their sense of self-worth is associated with that company. So if something goes wrong with that company, they sort of suffer their, loss of edit, almost like a existential crisis personally. So that's the type of the companies we look for, where people have soul in the game, and which basically means from our perspective that those companies are managed in a very highly risk-aware fashion. So, the owner is taking care of it because their entire self-worth is associated with that, then we can also, sleep well at night. The last thing here is that we also are quite valuation sensitive. So what we call our approach is quality at reasonable price, where we don't compromise on quality of the owners or the companies, but at the same time never overpay for those companies. And yeah, so that's really the approach.
And so, Ashish, when you're preparing for the Hearts and Minds conference, you're looking at a high conviction stock for the next 12 months. How do you wrap up that investment philosophy and then choose something that's going to perform over the next 12 months?
Yeah, it's a quite a tricky question. So, it's a very long-term investment approach. So we usually have 5 to 7 years holding period for any companies we buy in a portfolio. Some of the companies in the portfolio have been held for more than 10 years. So we really take a long-term view. But usually what we have seen is that the stocks which work on a slightly shorter term view, like 12 to 18 months, are the ones where the valuation anomaly is extreme, where something is going to change or correct over the next 12 months, which will, help the market price it more appropriately. So we apply this additional sort of criteria when we thought about which stock to pick for, Hearts and Minds conference.
Love it. Well, looking forward to your pitch on the 17th of November. If the Equity Mates community are interested in hearing the pitch, there is an option to be there live and buy tickets. There is also an option to buy an online subscription and watch it digitally. All the information for both will be in our show notes. So check it out if you're interested in hearing Ashish and all the other experts pitch their stocks on the day. But Ashish, you mentioned that you are an expert in emerging markets, and as I said earlier, it's a categorization for the majority of stock markets around the world that covers, the majority of the world's population. So it's such a broad categorization. Let's narrow it down a little bit. Were there any particular emerging markets that you found interesting in 2023?
Yeah, I mean, again, it's very, very good point, because emerging markets, again, they sort of club together for no sort of, rhyme or reason. You could say that, like, why Colombia or sort of Mexico is clubbed together with China or India, which is totally different countries, different points in the economic cycle. But I think one common element which sort of unites these countries is the fact that these countries do not have as a strong a rule of law, or as, let's say, developed markets like Australia, UK, or US. Also, the quality of institutions like, court system, the institutions around economic policy making, the democracy, those type of institutions are much weaker in these markets. So what basically it means from a minority investor's point of view like us is that a lot of things which you take for granted in markets like UK, Australia, US do not exist here. So there's no protection, not much protection for minority rights. There is no sort of activist investing and so on. So therefore, we think our investment approach, which is just focused on backing what we call high quality owners or high quality sort of owner managed companies, work very well, because ultimately what you're doing is finding good entrepreneurs, good wealth creators, and sort of backing them long term. Now, the problem, what we've seen is that a lot of times we do not find any of these entrepreneurs in countries, a lot of countries. So for example, in Russia, we have had zero investments for last 10 years because every listed Russian company we looked at or analyzed from bottom-up perspective turned out to be very close to President Putin. So that's a law we applied where, if any company we're backing or entrepreneur we're backing is close to the political power or politicians, we stay away because you don't really know when the political power shifts. So therefore, it's a very bottom-up approach, but from a top-down perspective, we generally like countries with better rule of law or at least some sort of, a checks and balances in the system. So answer your question, a lot of countries are ruled out under our investment approach. So I mentioned Russia, but Saudi Arabia, the same thing, because every company there is sort of linked to royal family. A lot of frontier markets are ruled out because they do not offer strong enough governance from our perspective. So the country we find interesting, obviously India is quite interesting to us. I mean, India, obviously there is a democracy there. Although rule of law is not perfect, but at least slightly better than most other markets in our universe. And there is a huge private sector or like the culture of entrepreneurship where you see a lot of companies listed in the stock market. We also find interesting companies in China at the moment. So China is harder for us. So our success rate of finding, again, purely private companies, with no links to politicians is very low in China. So we reject almost 99% of companies we look at China. But there are 1% of companies where we think they are interesting, and China currently is quite out of favor. So that it offers quite interesting valuation opportunities to us. So I would say probably China and India are looking very interesting.
So one of your key principles in the fund is not to try and predict the economy or the stock market. And you just mentioned there, India. That's an interesting example because, so many investors that we speak to, the sort of the basis or the thesis for investing in India is the economic potential and prospects over the next sort of decade or so, or even more. So then how do you take that principle and then marry it with, investing in emerging markets where so much of the company's fortunes are tied to the economic potential over the next decade, or, as you said, political fortunes?
Yeah, so no, we do think about economy, but we think it in terms of purely bottom-up perspective. So we don't really run a sort of country allocation model where we sort of decide let's go overweight India or overweight China. We don't do that. But when we are looking at from a bottom-up perspective, let's say a bank in India, we do think about what's the future sort of long-term growth potential of a bank. And if you're thinking about that, then you have to sort of somehow think about the economy. So, but we think about economy slightly different way versus many other investors, because we think that a lot of times the high GDP growth, do not translate into high stock market returns. So if you actually, China is a very good example of that, where if you look at China's GDP growth for last 15 years, it has grown the economy at 6-7% CAGR. But if you look at the stock price returns, it's almost close to zero. So your GDP growth has not turned out as good for your shareholders or minority investors. So what we look for is GDP growth combined with wealth creation opportunities. So I mean, the reason it didn't work out very well in China was a lot of GDP growth was driven by government. So government institutions or large government-owned banks, which sort of create a lot of GDP through construction or property market and so on, which was not really that wealth creation. So what we look for is, are the companies bottom-up perspective benefiting, and then do they actually create wealth or create value for shareholders? And we think India actually is an interesting country because not only the growth prospects are actually quite bright, like you pointed out, but also we think there's plenty of opportunities from a stock market perspective, which are private sector oriented, where entrepreneurs have a wealth creation track record whom we can back and back for long term.
I love that. So we want to get to a couple of key stocks later in this conversation, and that might draw out some of the themes that you're touching on there when it comes to your approach. China and India have certainly dominated the conversation around emerging markets, and it makes sense. Those two countries together are a third of the world's population. But are there any other emerging markets or any other themes that are emerging in these economies that you find yourself and the team spending more and more time on?
Yeah, I mean, again, a very good point. So, I mean, the broad theme, I think, which we sort of play long term again is I mean, it's not really a revelation, is consumption and sort of gradual sort of wealth creation in these economies. China, India is not the only ones. Like you said, it's actually Indonesia is very interesting as well. Indonesia is quite a large country and going down, the path of economic growth, which sort of other countries followed in the region. Not just that, we also think Mexico is looking very interesting. Mexico is also benefiting from nearshoring. A lot of companies which are moving out of China, they're manufacturing out of China, trying to now locate manufacturing in Mexico, which is very close to America. So Mexico is benefiting from that. We also like Chile in Latin America, Brazil. So there's quite a few countries, but the broad theme around this is that what we like is trying to play or trying to benefit from gradual middle class expansion, creation of wealth, and the other thing which is happening at the same time is that at least in China, the population is aging. So you not just have people who are getting richer, but also older, which creates opportunities in sectors like healthcare, which is quite interesting to us. I think the one other thing which is usually people don't talk about when talk about emerging markets is technology, where what we see, and especially, I live in UK, so I can just see the contrast between UK and India. So, India, for example, if you go now, a lot of times you don't have to use cash. So you can just use your phone to make payments. And same thing in China. China, you actually can't even use cash even if you want to, because most places wouldn't take cash. They just expect you to pay through your mobiles, which is so different from, let's say, in a sort of older or slightly more advanced economy like UK, where still a lot of people use cash. So we think a lot of these markets are leapfrogging in terms of their technology adoption. And they are actually in certain ways a lot more advanced versus, the traditional economies when it comes to use of technology and things like mobile payments, which actually opens up quite interesting opportunities from investing perspective. Last thing I would say is that these economies are not just consumption centers. Like you said, they obviously consumption centers because, large part of the world population live there, but not just that. Because once you have a winning business in, let's say, China, India, Indonesia, then you want to then win the world. You want to then expand your business outside your country and try to win market share elsewhere. So you see that all the time. A lot of Chinese businesses are now, trying to go out and win. Like you see ByteDance, TikTok, you see Pinduoduo, so many companies trying to go out and, win market shares abroad. And that's what you see more and more. So Indian IT services companies, Indian pharma companies, Chinese tech companies, they want to be global winners. And that's another theme which we try to benefit from, where if you identify a very high quality entrepreneurs, business family who was very ambitious and driven and hardworking, then you just back them for not just win their own country, but also win abroad.
Yeah, I love that. Well, let's turn to two specific companies and unpack some of these themes, understand what the companies do and why you like them. There are two companies that we've got from different, I was about to say different parts of the world. They're both from Asia, but from different countries. Uni-President from Taiwan, and then Kotak Mahindra Bank from India.
Great. Now, both very good examples, and they sort of also illustrate our investment approach. So Uni-President is quite and essentially one of the key tenets of our investment approach, like I mentioned before, is basically invest in companies which are slow and steady. So they're not going to grow 50% in a year and then collapse next year. So that's not our style. So our style is really invest in companies which are steady compounding companies which give you decent return every year and for next 15, 20, 30 years. So that's the type of company Uni-President Enterprises is. So it's super boring. Most people ignore it because it's so boring.
Let's get to it, but let's start with what the company does, because I haven't heard of it before and I'm sure a lot of others haven't. So let's start at the basics. What does it do? And then let's get into it from there.
Yeah, so basically Uni-President Enterprises, they sell noodles and tea. So they sell noodles and tea in Taiwan, in China. They also run convenience store chains in Taiwan and Philippines and China. They also have a food business in Southeast Asia. So it's a very boring business. It's nothing really changes from year to year. What they do, they actually dominate it. So they have very high market share in convenience retail in Taiwan, in Philippines. and they have very high market share in noodles and tea in China. So that gives them, their basically economics are very stable. It's a family-owned business where, again, family, their large part of their net worth is linked to this business. So they have really what you call soul in the game in making sure that this business stays well. So from our perspective, from a shareholder perspective, what it does, it gives you, if you look back last 15 years, for example, it has given you like 15% annualized dollar returns in that, with this business type of, very stable business. And the returns are a mix of earnings growth, cash flow growth, and dividends payout. So dividend payout is quite healthy as well. And this is what we like. We think if you actually look forward next 10 years, there is a very high probability that company will deliver the same, 14, 15% US dollar returns. From a free cash flow perspective, this is about 12 times or 13 times free cash flow, which is excellent valuation in our view. Yeah, so that's what we like about this.
It's funny, Ashish. We spoke to another Hearts and Minds speaker, Tom Norton, a couple of days ago, and he also he's also from the UK, and he also told us about a company, not the same company, but an Asian company that was big in the noodle business.
Noodles, yeah.
First Pacific from Hong Kong. So I'm not sure how familiar you are
noodles?
with that company, but I guess which company makes better noodles, Uni-President or First Pacific?
Yeah, so no. We know First Pacific very well. It's just that from an ownership perspective, that wouldn't pass our governance test, First Pacific. So it would not pass because we think there are issues around the owners of that company. So
I think First Pacific was also family run, wasn't it?
Yeah, it's family owned. Yeah, it's owned by a Salim family in Indonesia, Salim family is not something we will back.
Yeah, fair enough. So how big can a noodle company get? That's the question. What's the prospects for Uni-President over the next decade or so?
Very, very interesting. So like if you go back 20, 30 years, originally they sold noodles and tea in Taiwan. And, that's the origins of the company. And then they have convenience retail chain in Taiwan. So we think this is one of the first sort of companies where they figured out that if you control the retail channel, which they did, convenience retail. I mean, if you go to Taiwan, convenience is basically the main retail format because, every apartment block has a 7-Eleven, which these guys run. And people use 7-Eleven for everything, to pick up their breakfast. If they're walking out of the door to their office, they pick some dumplings in the morning from 7-Eleven for breakfast. And when they come back, they pick up, milk, groceries. They also use 7-Eleven to pick up the e-commerce parcels or, ship it back if they want to return the parcel. So it's basically their life. So they realize that once you control sort of such big hold on people's lives, then you can actually also sell more food products. So then they kind of started using their 7-Eleven stores to sell their own food products, which is noodles and tea and dairy in Taiwan. And that was around, I think, that's basically around the 80s and 90s when they built this business up. In mid-90s, they entered China, saying that, look, now China is the next market, so we need to be here. So they then started growing the noodles and tea business in China, which is still growing. I mean, it's quite surprising that it's sort of the volume growth is maybe not that high, especially Chinese, because they consume a lot of noodles and tea already. But what they've been doing for the last 10 years is they are premiumizing the products. So then tea, for example, they launched different variations of healthier teas, so less sugar tea and more sort of advanced teas, in the sense that if you use less sugar in a tea, the flavor has to be even better because people then taste the flavor. Because with sugar, people don't taste the flavor; they just taste sugar. So that you can charge higher price for the tea. Same thing with noodles. If you put more meat, more vegetables in noodles, you can higher price. You can actually, now they're moving towards ready-to-eat food. So not just noodle, you can have a hot pot, you can heat it up and then eat it. So it's actually higher price again. So that's really, to us, it's an example of constant innovation, and gradually sort of, with your same client customers, you know that you can actually get more wallet share with those customers. And that's really the approach. Then about 20 years back, around early 2000s, they entered Philippines. Thinking that Philippines offers what Taiwan offered in the early 50s, which is early stage economic growth and much larger population than Taiwan. And it's an island country, which they thought they can dominate. So they own 50% market share of convenience retail in Philippines. And they plan to do the same thing in Philippines, where they again launch noodles and tea in Philippines and gradually dominate the market. Once they do that, the next stage is Vietnam, which they're trying to enter. So It is just they sort of have the formula which they have perfected in Taiwan, and now they're sort of gradually rolling it out across Asia, which is what we love.
Yeah. You say, that you downplay it a little bit, they go into a country and they slowly grow, but having 50% market share in a country of, I'm not sure Philippines population, but I'm guessing somewhere between 100 and 200 million, that's a massive market and a meaningful market share in that market.
Well, yeah, they're very good at what they're doing. They are one of the best operators of 7-Eleven globally in terms of economics, the way they run their stores, and this idea of constant innovation. So, last time I went to Taiwan and visited some of their stores, they now launched, things like fresh food, fresh juices in their stores. So you could go to Taiwan 7-Eleven and get a fresh juice made for you. They have a really nice variety of coffee in 7-Eleven. You can actually pick a coffee from 7-Eleven stores, which is amazing. So just this constant innovation is what we like.
Yeah.
I haven't been to Taiwan, but we've experienced that service at 7-Elevens in Japan.
Yeah.
Unbelievable.
Yeah.
They had a deep fryer next to the cash register because the karage was that fresh.
Amazing. Yeah. Amazing.
So, Ashish, one thing you mentioned there, so they're a Taiwanese company, and you mentioned that they had a presence in mainland China. How do you think, is there risk there for Taiwanese companies with, a percentage of their business coming from mainland China? What's the geopolitics of that?
Yeah, so that's something we think about a lot. So in this case, the way we get some comfort is that the Chinese company has a Hong Kong listing. So it's sort of seen as a very local business. So although they have an equity stake in it, but actually it's got also have a local Hong Kong listing. And the Chinese company is entirely managed by mainland Chinese. So there is no remote control or managed from Taiwan. So the CEO of Chinese company is the mainland Chinese who has worked there for 20 plus years. And entire Chinese business is managed by mainland Chinese, which is quite extremely important. Those two things. And also we think, especially something like food items is one of the things where this is definitely not top of the agenda for Chinese government, because they are more worried about technology, things which matter from their national security perspective. So noodles and teas, perhaps the last thing they need to worry about.
So that was Uni-President Enterprises. Now, Ashish, we're just going to take a very quick break, and then on the other side, we're going to dig into an Indian company. So we'll be right back. Welcome back to Equity Mates. We're here with Ashish Swarup, Portfolio Manager and Investment Analyst at Aikya Investment Management. Now, we've just heard about one of the largest noodle manufacturers in Asia. We're going to take a bit of a different turn and move to banking in India. So the company is Kotak Mahindra Bank. I guess it's in the name, but what does it do, Ashish? And then why is it attractive to you?
Yeah, no. So it's a bank, like you said, and it's basically founder-owner managed or owner-run bank. It's founded by this individual called Kotak, who we think is one of the smartest entrepreneurs in the world, definitely in our universe. So if you go back in 1980s, he started this bank with an auto lending business. So it was used to be only focused on lending for cars and vehicles in India. And then eventually he turned it into one of the leading banks in the country. And the way he did it is actually amazing. So I have quite interesting story. So the way he runs the bank is actually two principles. One is that he wants to have a very strong deposit base. So essentially take care of the customers. The service of the customers is excellent. The leading bank in terms of the service. But at the same time, he runs the lending book with a very high level of risk control. So, his track record in terms of credit costs or in terms of, loan losses is one of the best in the country. And this is what we like, where if you step back a little and think about Indian banking industry, so Indian banking industry is quite interesting because about 70% of Indian banking industry is dominated by state-owned banks. And state-owned banks usually, are not run for minority shareholders. They run for, policy objectives. So if the government wants those banks to lend and juice up the economy, those will lend. But their losses are enormous because they don't really think whom they're lending to, because it's not their money after all. It's shareholder or it's taxpayers' money. So Therefore, a lot of those banks from time to time blow up, and their service is not very good. If you go to those state-owned bank branches in India, the service is not very good. So people are not very happy. So they lose their customers, deposit customers quite easily. So 30% of the market is dominated or controlled by private banks like Kotak Bank. And Kotak is one of the leading private banks. And gradually, those private banks are gaining market share against those state-owned banks, as you would expect. Now, the other interesting thing about Indian banking industry is that Indian banking penetration is extremely low. So India is still a poor country, and a lot of people do not have proper bank accounts. Even if they do, they don't take loans. So the lending penetration is one of the lowest in the world, especially for consumers. And that's where the sort of Kotak or Kotak Mahindra Bank focuses on. It's largely consumer-driven bank. They're not really driven by corporate. And consumer and small, medium enterprises where their bread and butter is. So if you then summarize, if you go back 25, 30 years, they've compounded their book value at close to 15-20% US dollar terms. And we think given the nature of opportunity in front of them, they can easily do it for next 20 years. And for that, we think the valuation currently is very attractive.
It's a fascinating story. We've had an expert speak about HDCF Bank. Is that HD or FC Bank? Yeah. And they spoke, I guess, some similar themes. In a large country with an underbanked population, they spoke about it being a well-run bank, and there was a lot of opportunity there. With such an underbanked population, and Reliance Jio is pushing ahead with like the world's cheapest smartphone, and it feels like India is primed for a lot of people to embrace digital payments before traditional banking with these cheaper smartphones, and as they get people online. How do you think about the competitive threat from a Reliance Jio and some of these tech companies that I believe they're also pushing into banking? I think Jio has its own bank. How do you think about the coming competition there?
Yeah, I mean, again, very good question. So let me say two things there. One is that, so a lot of these payment companies we've seen, not just in India, I mean, elsewhere in our universe, come up and at least, be very successful in opening new accounts. With clients, customers, and at least threaten the banks from a deposit taking perspective. But what we've seen is that banking is a bit more than just deposit taking or payments, because banking is a lot more about managing risks. And I mean, in a country like India, where there is not much history really of lending and borrowing, what you can see is that lending money is very easy. You can give money to anyone you want, but collecting is very difficult. So people just taking the money, getting the money back is very, very hard. I mean, you have models like Afterpay in India where people just give in money because you're just buying online, but then those default rates are massive in those cases because collecting money is very, very difficult. So that's where we see a lot of these newcomers in the industry may falter, because they coming from a tech background. They're technology companies and they're not financial companies. And as a technology company, your discipline around collection, discipline around credit risk control may not be as strong as a traditional banker. So that's I think the first point around to highlight. And you've seen it elsewhere. So you've seen it, a lot of the new banks in Brazil, for example, blew up recently because they just couldn't control their credit cost. And you've seen that actually in case of some other markets as well. Now, the second thing, which is actually makes us a little bit more comfortable on Kotak, is that Kotak is the leading digital bank now in the country. So their app, we call 811 app, and the sort of digital sort of bank is actually the leading bank, and they're collecting a lot of sort of new age sort of customers in their 20s, and they are also one of the biggest payment processors. So they also embrace technology, and they're very quite advanced in that. So that gives us a second level of comfort.
So if you're looking at Kotak, if it successfully executes, how do you expect it to grow over the next decade? How big can this get?
Yeah, so we think Indian, let's say GDP growth, which we think quite conservatively can grow 6-7% a year in terms of dollar sort of real GDP growth. And then slightly more in nominal terms, it's in dollar terms, the 8-9% nominal GDP growth. And we think what India, the stage of the economy is, usually the banks or the bank credit grows at a multiple of GDP growth, like 1.5 times typically. So it's like the system credit can grow 12-13% easily. Kotak, on the other side, actually gaining market share. Like I said, Kotak systematically gaining market share against the state-owned banks. So Kotak will grow 1.3, 1.4 times the system growth, which is 16-17% loan growth, with a very high return on equity. So the return on equity is actually very high. The capital base is very high, so they don't need to issue more equity. So we think it can easily compound its book value at 20% plus over next decade. And this is what actually is done if you look back of the history of the bank. So. And and it's always kept its multiple, price to book multiple. And so it sort of gives you at least 15-20% return in dollar terms. That's essentially why we like it so much.
It's fascinating. Ashish, before we wrap, while we're speaking about Indian banking and financial services, I want to ask you about one other company. And if you haven't looked at it much, that's okay. We had an expert come on the show a couple of months ago and talk to us about Bajaj Finserv and the amount of data they were collecting and what they were trying to do with that data and how they were trying to predict like customer behaviors and then allocate, I guess, their resources accordingly. Have you had much of a look at that company, and what do you think?
Yeah, so I'm actually a computer engineer by training, so I'm quite a bit skeptic when people talk to me about how to use algorithms to predict stuff. So, but look, we have looked at Bajaj Finance. We've analyzed the company, and it's a great company. Look, they have very good track record, at least in the near term. So, what we look for, in addition to those algorithms and technology, is that what we look for is an evidence of successfully navigating down cycles. So we think your lending book or your quality of lending book is not really proven till the time you've actually gone through some bad economic times, or just to see how your book behaves when times are tough. Because in good times, everybody can claim to be high quality. So when the bad times hit, only then you test who's actually good and who's bad. So we think in case of Bajaj Finance, they have not really been tested through bad economic cycle yet, because India has been only doing well since 2012-13 when they actually became big. So we think we're just waiting for them to see how they behave during bad times. Kotak, on the other hand, has successfully navigated several bad cycles. That's why we like Kotak more.
Well, we did a deep dive on that company with Saurabh not too long ago. So if you're interested in hearing more about it, check it out in our podcast feed. But Ashish, that does bring us to the end of our conversation today. Thank you so much for your time. We're very much looking forward to what you're going to pitch at the Sohn Hearts and Minds conference. And if you're listening along and you'd like to find out what Ashish, along with many of the other experts from around the world, will be pitching at the conference, there is a link in the show notes to grab tickets. The discount for the Equity Mates community is Equity Mates 2023, all one word, and that'll give you 20% off the virtual tickets. The conference is on November 17th and all proceeds go towards medical research. So it's a fantastic conference. We wish you all the best, Ashish. Picking stocks for a 12-month period is probably one of the hardest things in the game.
Yeah, we don't envy you at all, but we wish you all the best. And yes, we hope to see you when you're in Sydney.
Yeah, thank you. Thanks for having me.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.